Hello, the price of oil hit a 4-year low this week, closing in on $75. But what is causing this price decline, and will it go lower? I'm talking oil today with Thomas George, who is portfolio manager of the TD Resource and TD Energy funds. Well, Thomas, huge decline that we've seen. What's causing it? What's behind the scenes?
Yeah, so what's happening right now and what we've seen since July, can I just take a step back in terms of what are the fundamentals that are driving this? There's two key fundamentals. Since July, the largest fundamental criteria that we think's happened has the IEA has taken significant demand revisions, global demand revisions for oil, and that's really been driven by economic weakness in both China and the European broad union.
So people will use less oil.
Exactly. So that's been one key part of it, and the second part of it is also we've seen an increase in production in Libya. So this has caused a supply-demand imbalance that effectively is creating the current volatile environment for the near-term oil price.
So we heard today about the U.S. elections, and it looks like it's maybe more positive for the Keystone Pipeline. Is Keystone really such a big deal? Yeah, so it's a good question. From our perspective, Keystone is still important for Canada and the oil sands, but we believe over the long term, we've seen significant changes in crude by rail. We've seen a ramp up in delivery by crude by rail. So we think that has really played an important role over the near term. So not as important, but on the margin, we think it would be a positive outcome. All right, and where do you see oil going? We've got all this volatility happening right now. What's your longer term view?
Yeah, if I can step back, so from our perspective, our fundamental long-term thesis for oil equities is based on a view that the long-term oil price trends towards the marginal all-in cost of producing a barrel of oil. And that's that 95th percentile is roughly around $90 to $100 per barrel. So that, we believe, over the long term, you can see has had a strong relationship with the price of oil. Now, you do get near-term variances in the price of oil around that, and that's with regards to the short-term inelastic nature of both oil supply and oil demand.
So people can't exactly just stop using energy.
Exactly, and that really is the story, right? So from let's take the demand perspective. It's really hard for consumers to change their oil consumption patterns on a weekly basis, depending on the price. So it's not like we can store the oil. We still drive to work on a weekly basis. And then on the flip side, on the supply side, oil producers, just because the high capital intensive nature of oil production, it's very hard to ratchet up or down production based on price. So you get this dynamic where if there's a small imbalance, relatively small imbalance like we're seeing today, you get large price increases or drops in the price of oil over the near term. But our view over the long term is that prices should trend to that marginal all-in cost, which is above $90 per barrel.
Above $90, okay. And then with suppliers, obviously, how long would it take them roughly if we stay at this level at least in the short term? Do you see people stop producing because it costs too much now?
So I think you hit the key point, right? So we've got this gap, this supply demand imbalance. What do we need to fix that market? So I think there's three key points that we need to that can fix that. First, we have a meeting in November 27th, the OPEC meeting, and they can fix this immediately if they wish. So we're going to be all eyes on that. So OPEC can play a role here. Second, the U.S. supply. So U.S. has been the juggernaut of global oil supply. What we're going to see over the next 6 months to a year is how the marginal U.S. oil players react to this lower price point. So that is also a driver that could fix this. Lastly, we just see demand come back. So what's really been the cause of this from our perspective has been lower economic growth in China, Europe. Now, if we see that increase, if we see better growth prospects over the next year, that can fix this as well. So there's different levers that can be pulled here. We're going to be watching each one of those closely, but those ultimately are what bring this near-term supply-demand imbalance back to balance.
Okay. And then also looking at other countries like China, who has been such a huge demand for oil. What's going on there?
Yeah, so in terms of China, it's an interesting point. So for China, historically, industrial production diesel has been a key input for industrial production in China. That has effectively gone flat. So use of diesel diesel usage is basically flat. But what's interesting on a positive side is gasoline consumption is up 10% year over year in the country. So in terms of becoming more consumer focused, you're starting to see definitely green shoots of that. So I think we're still very constructive on oil consumption in China. We just think it's going to be a different mix.
Okay. And everything going on in the Middle East, is that another temporary?
Yeah, so there's significant geopolitical volatility in the Middle East. What we believe currently, we believe there's there's very little being priced in the oil price today for all that geopolitical tension. And bottom line is, we believe the marginal production that has increased in the region is in weak hands. These are all regions that are dealing with their own dealing with their own issues, political issues within the country. So from our perspective, it's a volatile region that has not gotten less volatile, it's only gotten more volatile. And then our perspective is that right now, very little is being priced in on that front, and we could wake up one day and see a premium step.
See a spike in the oil price. That's interesting. So if I'm sitting here as an investor and I'm looking at energy, oil, and I'm thinking, this is crazy. There's too many factors. What do I do? What do you do in this type of situation?
So stay calm.
Exactly.
is the most important thing, and understand that we're dealing with a commodity. But I think really focusing on that long-term marginal price really takes away that short-term noise. So fundamentally, understand where that long-term marginal incentive cost to produce a barrel is, and we believe that $9 is a key point there. In terms of how we think about it. And how we position ourselves in terms of our portfolios, what we think about is owning quality companies. And I think that leaves you in good stead during volatile times and during good and bad oil markets. So what we first of all look is good quality management, good quality resources, and a strong balance sheet. And ultimately, companies that deliver tangible returns to shareholders and have demonstrated that over the long term. Those are the types of companies that really weather the storm.
Thanks very much, Thomas. I've been joined by Thomas George, Portfolio Manager of the TD Energy and Resource Funds. I'm Marianne Devenney. Thanks for watching.